The consumer price index rose 0.3% in the month of January. The all items index rose 3.1% for the 12 months ending in January. So economists predicted the number would increase 2.9%. On an annualized basis. I feel like I'm just spitting out a bunch of gobbledygooky numbers. I don't even know what I'm saying. So joining me now in Studio 57 is CBS News business analyst Jill Schlesinger. That was like a little more inside than I expected. Yeah. So please make this all make sense to us.
Okay, prices are not going down, but the rate of inflation, the rate of the increases is coming down.
Okay.
That's the good news. All right, great.
Yeah,
we'll take some good news. Yeah. Remember, we were up at 9% in the summer of 22. Now, as you just said, 3.1% on an annualized basis, still higher than what the Federal Reserve wants. So what is behind the number? The January number was stronger than expected. I am going to put this all on one component specifically, the shelter index. Okay, shelter.
What is that?
Okay, it's like how much are you paying for your housing?
Right, okay.
Now, the weird thing is there's two ways to pay for housing, right? You can have people who own a home, they've got mortgages. They are not actually experiencing inflation for their housing costs because they probably have mostly locked in mortgages at very low rates. But to make the data consistent, what the government does is says, hey, you live in a house that you own. What would it cost you to rent that in the marketplace? That's called the rental equivalent index. Whatever. It's total pain in the neck to think of it that way. Then there's actual rents. When we put it together, the shelter component actually accounts for 2/3 of the overall consumer price index. So when you said 3.1%, this is all about shelter. Shelter accelerated at a 6% pace from a year ago.
That's a lot.
But here's the thing, it's weird. When you go to apartments.com, when you go to Redfin, it shows that actually rents are coming down. It has not been reflected in the government data. This is one of the reasons why economists are like, wait a second, that number doesn't seem right. But it's the number we have. So again, big picture, the rate of increases, the rate of inflation is coming down. However, there are certain aspects of this report that do jump out, like shelter, like motor vehicle insurance, by the way. I just got my renewal, up 20% from a year ago.
Yikes.
So these are the kinds of things that stick in the craw of consumers.
Right, yeah, and it's a good reminder that this is all data that's like backward looking. So that's why maybe when you get online, you don't see it being reflected. But of course, everyone wants to know, well, what does that mean when it comes to the Fed? How are they going to interpret this? What are they going to do about interest rates?
It's been 3 years since we've been under 3% in the inflation rate, let alone the 2% inflation rate that they want. So we have a meeting in March. I think there's no way they're going to cut interest rates if this is what the data show us.
Yeah.
Then the next one's in May, and then we've got a June meeting. So, I mean, they'll cut eventually, but they're not cutting right now. Why should they?
Yeah.
You know, there's a couple of aspects of the economy that remain stronger than they'd like. Not only is the inflation rate strong, but the job market is really strong. And the wage component of the Labor Department's report is kind of showing that people are paying up to get employees. Wages were up 4.5% from a year ago. So the Fed is concerned. Hey, as consumers make more money, what happens? We spend more money, and that can help keep inflation higher.
Right. So before we let you go, I'm going to ask you about something completely different. The stock market's like gangbusters.
Bananas.
Yeah, what's going on?
I promised I was going to teach you something fun today,
okay,
right?
I
like to introduce a new concept, and you teach me something every single day. So there's something called the Magnificent Seven. Heard of it or not heard of it?
Never.
Fun. Okay, here we go. There are 7 stocks that drove a lot of the stock market's returns last year. So, you ready for them? They're the big tech stocks. Meta's one of them, but let me go in order, otherwise I'll never remember. Amazon, Apple, Alphabet. So those 3 A's. Then there is Microsoft Meta, NVIDIA, big chip maker for AI, and Tesla. Those 7 companies, total return last year, 111%.
Wow.
The S&P 500 was up 24.25%. And so when you think about stocks going higher, I want you to think of 2 things. Wow, that Mag 7 really drove the action. Big tech continues to be a huge component of the overall stock market. So on Friday, last Friday, the S&P 500 crossed over the 5,000 level, first time ever. We got a new record in the Dow, but who cares about the Dow? It's only 30 stocks. The Nasdaq was up by more than 40% last year. So companies like these are making a ton of money. And at the same time, we have other companies that are doing things like saying we want to be more productive, we want to slim down, and it means that they're laying people off so that they can streamline operations in order to be able to deliver earnings to their shareholders.
Right, that look good.
So the reality is these two things together, many companies making a lot of money, some companies saying we're not making money, but we're cutting our staff down to actually make sure that we do make, or at least don't lose money or stop losing as much money. This together brings the stock market higher. There's a lot of good happening in the U.S. economy. If you lose your job, I know it stinks if you're one of those companies. On the other hand, if you're a shareholder, you own it in your 401k, you're pretty happy. And so we have to actually kind of hold both of those duality, that duality in our minds.
That's
compassion for the person who loses a job and happy that you own a stock where the company's doing okay.
Exactly. 401ks have not looked good for a while. So that is a bit of a silver lining. Hey, always good to have you. Thank you so much.